Oh, I'm not in the mood for this. I miss my robot. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW Notes, affiliates, or any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacity licensed financial advisors, registered investment advisors, or registered dealers. Nothing in the webinar website promotion material constitutes promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services meant to teach the risks and potential rewards. Trading options, we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and the results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By access of the webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By access to this webinar, you agree to be placed on our mail list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Boop, 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 boop. All right, fantastic. What the frick is that? Oh, hang on. That's my door. That was good timing. I'm here back. You're right there. So now my lunch comes. I ordered over an hour ago. So sorry about that. Anyway, all right, here we go. That is a very long time for them to deliver. And I'm freaking starving. Anyway, hang on a second. Let's have a bite. Okay. All right, so we're done with that. Moving on. The indexes are coming back down to like interesting levels to play long, so we'll keep an eye on it, but they look, this is scary weakness. It's not good. I mean, this market is not looking healthy at all. So you have to be very, very careful right now. Sri says, every time I think I finally got the hang of your option plays, you pull a whole new can of hoop. Loving your recent moves on the board. Yeah, we're going to do that. We're going to talk about the portfolios and why we're changing things and what we're looking at. You know, one thing you got to look at when this happens, the Russell getting very weak. Watch this 1500 line. This, see, should be bouncing. And now, let's look on the futures chart. It might be easier to see, hopefully. Not that. That. Okay, so we tested 1500. No, that's too short. We tested 1500 yesterday and had a really sharp move back up to 1540. We're down from 16 to 15. So if you're down from 16 to 15, that's a 100-point drop. And 200 points then is a, I'm sorry, the 100-point drop means 20 points is a weak bounce, 40 points is a strong bounce. So here we go, you went down. We have a weak bounce of 20 points from a 100-point drop. Then we had a strong bounce. Then we come back down. We just failed the weak bounce, but held it, bounced off the weak bounce, failed it this time, all the way back down to here to support. And if we fail at 1520 now, that's going to be a very bad sign. It means things are weakening, you're stepping down. So we're going to keep an eye on that. So I do think we're going to get a bounce to 1520, but after that, it's a very dicey thing. So these little bounces that you can play for are harder and harder to play. And this whole pattern is just part of a stepping down pattern that's over a longer period of time. Look at this. It's horrific. You know, we get down to 1450, we get some major problems if we don't hold that support. Right now, we better just hope 1500 holds, so we're back into where we will be seeing 1450 again. But here's 1500, so that's the main point, that's the star of this thing. And so we want to play 1500 long. Keep an eye on the other indexes to see when they turn. Oh, this is the oil made $880 earlier playing oil. NQ, yeah. So you want to see if everybody's turning or if everybody's failing. So I would most like to play the Russell since that's a very good, this is a good failure point too on the S&P, the 27. So we want to just take a look and see what happens. The low is 1502 though, so this is getting very, very close. But everybody's red. There's no reason to jump in. If everybody's red, that's not a good time to be jumping in, right? So let's keep a sharp eye on this 1505. 27, there's too many bounce lines though. It seems very unlikely that everybody's going to fail all of a sudden. Nothing happened, that's why. That's a factor, by the way. Nothing actually happened that would make me think it would go lower. 1503. All right, I gotta go with one here. I'm gonna get one here just in case. Oh, come on. Boo. All right, that filled. So we'll buy another one if we get to 1500 and we'll average 1503. But I don't want to miss it if it turns all the way back around all of a sudden. And like I said, the point is there's no news, there's no reason for this stuff to be happening. So you can't, you know, you got to factor that in and say, well, it's going down for no reason, then it shouldn't. It's less likely to break through a major resistance line when it goes down for no reason. So you can't wait for it to exactly hit 1500 because it's not likely to do that. So you want to jump in when you can. Now, of course, now we're bouncing for no reason. The only reason we're bouncing is because we hit some technical support lines. So that's not even a good reason for it to bounce. But see, this is what I call a W pattern. So we try to make a W. It's going to at least try to get back to this, or at least what you would say would be the descending angle here. So we should see at least 1510 here, which is going to be good for a few $100. If we don't see that, this thing's in big trouble. So do I want to add another one here? Not the way it's, yeah, I do actually, right. All right, here we go, 1503. Didn't get it. Well, all right, there you go, that was easy. That was a little too easy. You don't want to get an easy fill down at 1500, so we're below now. So that's how you turn a winning position into a losing position. So now I'm watching to see if these guys are not red. So it seems like he's red for not a particularly good reason. If I add more down here, I'm going to get my average down to 15, which is what I'd like to do. Oh, come on. All right, right here. Add one more here. Yes. If I add one more, I'm going to be there. Don't really want to overpay. So now I have 3, and my average is just a teeny tiny bit over 1,500. If I added one here, I could bring it down to 1,500. But if I get out of one over here, it'll accomplish the same thing. So there's no reason for me to jump in and add one. It's not life and death that I'm exactly 1,500. It's just more easy for me to keep track of if I do that. So I prefer to have some kind of a round number. So looking, where else is there support? I mean, this is a failing W here. This is barely holding up. He's also a failing W. These are bad signs. When the second part of the W is lower than the first part, that's not necessarily a strong sign. Oh, remember what I said, if I get out here, watch what's going to happen. Now my average is 1499.85. Now my average is below 15. So now I can use the 1500 line for a stop line and be guaranteed not to lose money. When you scale in, you have to remember to scale out. Otherwise, what's the point of scaling in? You don't just scale in and then keep it, because then you're just making a bigger and bigger bet. The whole point of scaling is to lower your basis so you can get back to a nice small bet, a nice small comfortable bet at a low average strike. So we have 2 contracts long now, just below 1,500. And the premise is that 27 is going to hold, and well, let's say 69.75 for lack of a thing here. We're expecting things to hold up around here. It's not looking very pretty. I don't have a lot of confidence in this right now, unfortunately. This is already, the W broke badly. And it doesn't seem enthusiastic about coming back. But I don't see any actual reason for any of this to be happening. I could cut back to 1 contract. That'd probably be the sensible move. When in doubt, don't trade too much. So let's see what happens. We'll give it a couple of minutes and then we'll get on to something else. Wow, look at that. That's terrible. That's probably a bad sign for all these guys. All right, so now we're at 14.99. So I'd say to myself, if I add one more here, what's going to happen? I'm going to average maybe 14.99.50. And is that worth it? Now 98. So do I want to average 14.99.50? Do I still think we're going to be bouncy? And I look at the other indexes and I say, yeah, they look kind of bouncy. So why not? Oh, I might have blown my chance. Oh, wow, way down there. Okay, let's do that. Now my average is 14.99.36. So very anxious to get back now to a lower strike, to a lower amount. If these guys all turn red, though, I should get out because it's not good. Because he's going down. The premise was they were going to hold, but if he doesn't look like he might not even hold this line over here. Wow, look at this thing go. Well, the next biggie is his test of 2,700. I think I'll leave it till there and just see what happens. Oh no, look at that. Bad, bad, bad. Where am I? 14.99. I have to get 2 points higher to get even there right now. That's not good. And again, we're playing for technical bounces. There's no reason, like nothing particularly happened that makes us think that we should be much higher. But we have the beige book coming at 2 o'clock, and I think the beige book might be a reason for people to say, hey, you know what, the economy looks pretty good. And then I could start some short covering, which would be kind of nice. Look at that, all the way down to 69.50. But 69.50 was the low before yesterday. But here we're miles above the low. And here we're quite a bit above the low also. And here we're, of course, below the low from yesterday, which we were hoping would hold. So our last hope is the Dow. If the Dow fails this line, 24.9, and if he fails 27, it'd be silly to stay in these, even though you got to take a loss and move on at a certain point. But that is not pretty. So either we're staying in or we're getting out, depending on what happens here. Wow, he's just hanging on. See, he came right to the line. He came back up. But the S&P is the one that matters most. And it would be weird for it not to bounce a little bit. I mean, just, at least come back to 2720. Just make an effort of some sort. Oh, look. Oh, thank goodness. Okay. So now we get back, and now we're at 14.99 on the average. Now I've got 2, so I'm comfortable again. See? Like I said, you got to remember why you were scaling in. We were scaling in to reduce our cost basis. That was why we were scaling in. I didn't have conviction because I'm only playing for a technical bounce. That's not a conviction play. It's not like I know something or I feel strongly something's going to happen that's going to move the market higher. I don't have that. What I do have, though, is a pretty good idea that if we had this kind of bounce off of yesterday's low, and right now we're down for no particular reason, that I would expect that we would at least do something, at least come back to this spot here before failing. And it'd be very hard to test it all the way down, for nothing. Doesn't mean I'm right, but that was what I felt like, based on my, if you want to look for a play, that's what you have to do. You have to construct a premise and say, okay, this is what I think is going to happen. If it starts to happen, you play it. But only technical. So depending on how these guys now perform, as far as weak or strong or whatever, that's what we're going to decide. If he has trouble at 7,000, we should get out of the play, right? Because if we're going to bounce, the NASDAQ should go right back over 7,000 as if it's no big deal. And if the NASDAQ can't do that, then why would I expect my guy to get over his line? It wouldn't make any sense. All right, but so far so good. We'll see what happens. Get back to that a little bit. Anybody got questions? No questions. I'm doing such a phenomenal job of explaining this stuff. Okay. Up 1502. Very nice. See, how's that? $300. How long have we been doing this? It is 20 after. So we're making, I don't know, $100 there, $150 every 10 minutes for you guys. That's pretty good. And I'm getting lunch I'm eating my lunch while we're doing it. So that's pretty nice. Good multitasking. Now the Dow is a good long over 25 because it's an easy place to stop out. Obviously, this line is a good place to go long. And like I said, we're going to hit a test of 7,000 here. And if we pop 7,000, then I got a good chance of a nice run up in the Russell. But it's horribly weak. It's not good. I'm not very encouraged by the movement right now. Here's 25,000. We don't want to see that getting rejected. And if it is, then we take the money and get out. That's all. 2503, good sign. Always check 2503. He's good. He's still above his line. He's coming towards his line. Up. Rejection. 90, 89, not good. 08. 07, not good, so time to cash it in. All right, sorry, only 230. It doesn't look good. I just don't have that good feeling about this thing because he's failing over here and he's failing over here and he's getting weaker. So why stay in it? All right, so good. Now we can move around and come back to that later. All right, but I mean, we made $230, so I feel like, we're not totally wasting our time. And that's the same thing, by the way, your risk tolerance, because you have to say, how much do you want to make? What are you trying to accomplish? If you're only willing to lose $200, then you should be thrilled to make $200. It's got to be proportional. You can't say, I'm only willing to lose $200, but I want to make $1,000. It's not realistic. It means that means you're never going to cash in a $200 win. You're only going to cash in a $1,000 win, and meanwhile, every time you lose 200, you're going to cash out. Consider every single bet you make in the futures to be 50-50. And basically that means you want to risk less than you're going to make, But you have to have a good reason for that. So you want to use these stop lines. You want to find stop lines, use them, and stick to it. And you have to say, if this does that, and that does that, and that does that, then I'm in, and if not, I'm out. So right now, even he's up a little more than we got out, but he's getting worse. So there's no, it's all, yeah, it's not good. I would look to play the Dow now over 25 if it gets over. But or I could play him back at 15 because he's getting back towards 15 at this point. But again, it's not strong. It's not a strong recovery. It's not like the kind of zoomy up thing that we're used to. So it's not good. And what's the dollar look like? The dollar is very strong. That's also a problem for the indexes. Let's see. How's oil doing? CL. Got that 1 o'clock report, but I didn't feel like I'm not looking at that right now. Somebody says the market just does what you say. Amazing. No, it doesn't do what I say. I wish it did. When would you play short? You play short the same way. If you think things are getting worse, then you play short. In fact, this morning I laid out lines. I don't want to get into the whole thing, but early this morning I said, if I ever want to find somebody who knows what they're talking about, I look at my own articles. What did I say? I said something out of long or short. Okay. This was brilliant. So yesterday, blah, 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 here's the lines. These are the lines we're looking for, right? So I said, here's what was happening. The Dow was green. All right, weak bounce line, strong bounce line. Not going to get into the whole hows and whys of that again. So take it for granted, though. These are our bounce lines. So our bounce lines are here. We have weak and strong bounce lines that we calculate using our 5% rule. And a lot of this stuff is now. We have the ebook online. If you go up to the top of the page, you have the new members guide, and you can find all this stuff explained all in these places. We have the ebook, the TA book. There's lots of places you can look for resources. We have the education section over here. So there's all kinds of places you can find all this stuff if you want to dig into it. But very simply, calculated we did in yesterday's chat room, we calculated the lines. We came up with these. Turned out we basically nailed them as far as performance. This morning, most of the weeks were green. The Russell was at, so when I make it black, it means it's at the line. So it's not red or green, it's black. It's right at the line. So the Dow was right at 25.3, which is a strong bounce. Can't see what I'm doing. I'm putting one hand up. So the Dow's at 25.3, that's a strong bounce. And the Russell, putting my hand down on the other side, is at 15.30. That's a weak bounce. So since the others are all in between, they've all crossed over the weak bounce. That means depending on which way the two of them go, that's the direction the market's going to go. So if they both fail, if the Dow fails 25.3 and the Russell fails 15.30, then everybody's bearish. If the Dow goes over 25.3 and the Russell goes over 15.30, then they're both bullish. Now, obviously, since the Dow is the one that's up, see my hand way up here, since the Dow is up at the strong bounce line, higher than any other index, and the Russell is down, low hand, at the 15.30 line, if the Russell fails 15.30 and goes below the weak bounce line, the Dow fails 25.3, then the best thing to short is easy, right? It's the Dow. You short the Dow at 25.3. That's what I said here. In which case, short the Dow below 25.3 with tight stops. So then what actually happened today? And I'm going to see on the hourlies. You can see on the 5-minute chart. Yeah, did. Okay. So, yeah, well, here's 25.3. It failed pretty hard though, right? It was like, because I'm writing these things pre-market. Here's 9 o'clock, and here's around when I was writing it. So the Dow's failing 25.3, the Russell 15.30, right? So when the Russell goes below 15.30 and the Dow's below 25.3, you short the Dow, because that's a logical one to short, and get a ride all the way down to 24.9. That's freaking 400 points. That's $2,000 per contract, just using that simple logic from the Morning Post. It's not actually that hard. So the markets don't do what I say they're going to do. I'm just able to say, if the market does this, then we should do that. If the market does this, then we should do that. And we've got enough signals where we know which ones are flashing. Not 3 week. So this was a $2,000 gainer from the from 25.3 down to here, $2,000. It's fantastic. And then I think we played it for bounce in chat. Yeah, we did. That's right. Then we played for chat and picked up 200 points the other way. This is not hard. When I retire, that's all I'm going to do. Yeah, my plan when I retire is just to play the futures every day. Mm-hmm. Oh, my daughter finished her job interview. I hope it went well. All right. Let's see. So let's see. John says, so we cashed in some of the SQQ hedges not long ago. It looks like the market weakness is persisting as a new hedge, suggesting a replacement. Okay, John. I don't know if you're a PSW member because this is an open thingy, but whether you be one or not, today, what we did is we had in the short-term portfolio, we had SQQs, and we had, I don't know if it was a tens or whatever it was, but we had a lot of, I think we had 160 of the March 10 calls. So we cashed those out because they were almost at $4, which was how big the spread was. So we couldn't make more money from our covered calls. And also we didn't think we were going to go past 14, but now that we're looking weaker, today we just added in our chat room, Control F. So now I said in the at 1040, I said in the short-term portfolio, by the way, it's 1040. You guys want some context. So 1040 was right about here. Oh, well, let's look on the NASDAQ. Hang on. So 1040, we weren't too weak, but we weren't too strong. We were below 7,100. I didn't like it. So I said, NASDAQ failed 7,100, not good. In the short-term portfolio, we have 80 naked short March 14 calls. I'm still iffy about covering, but let's not take too much risk. So we pick up 80 of the June 12, see we're below 14, the June 12 and above 14, 17 bull call spreads at 130. So rather than buying these back to 213, we spend $1.30 on $5 spreads in June. So hopefully still these do expire worthless, and then we have these things for longer protection. And don't forget their insurance. We're not trying to win. We just want the insurance to be there in case the market drops unexpectedly. Right now, it's nothing unexpected is happening. It's doing pretty much what we thought it was going to do. But that's how we adjusted that cover. Also, we have that TZA, Control F, TZA. Oh yeah, I talked about that this morning. So right here in the Morning Post. Okay. And by the way, if you sign up, oh, here, let's do a commercial. If you sign up for a premium membership, for an annual premium membership, it's up. If you're not a member, well, if you open in an incognito window, you would see it. Or if you log out, I'm not going to log out. If you open it, it says become a member today, and then you go subscribe. Nope, that's not it. Where's my subscribe page? There, click here to become a member. So if you sign up for a premium annual membership for $99.95, and you only get billed quarterly anyway. So if you sign up for an annual membership, I pick now my trade of the year, and Now, trade of the year is going to be this pot trade on MJ ETF. And I said this is, now, we're doing, we're selling the $30 puts for $7. We're buying the $25 calls for $9.50, and we're selling the $45 calls for $5.25. That nets you in for $1,500 on the $40,000 spread. And it's always down today, so it's a good day to get in. And anyway, and so your upside potential is $38,000. And I said, if you sign up for an annual $10,000 annual membership today, or by the end of the month, if this trade doesn't make $10,000, this trade right here doesn't make $10,000 by 1 year from now, basically, then we will give you an entire another year of PSW for free. So that's my trade of the year guarantee. This trade is scheduled to make 2,566%, but I'm going to guarantee 600% of it. All right, so that's my plan. So I feel really good about that one, but that was above. I just want to make sure people saw it because Seeking Alpha deleted that. They don't want me to promote my stuff on Seeking Alpha. So they didn't show it to anybody. Where are we? Oh yes, TZA. Now, I love, by the way, these MU short puts. I love this trade. Let's see where they are now. MJ, I'm sorry, not MJ, sorry. Well, MJ's not bad, actually. MJ, how much are those short puts? I'll jump to conclusions. See, the short puts on a trade like this are an offset, so it's anything you would really like to own for the price. So you could, I mean, hell, you could sell 10 of these, which are much cheaper, actually. You can sell 10 of these MJ 2021 27 puts for $525, hopefully a little more than $525. But you sell that, you get $5,000 for those. Anything that you want to sell that you think you might want to buy later. Now, for the purpose of that trade, we used Caterpillar because I thought Caterpillar was a little bit oversold yesterday. And it's actually lower today, so maybe I'm wrong. So the 2021 puts for $10. The whole point is just to raise $5,000. You can use any stock you would like to own, but in our long-term portfolio, we have no problem owning a bunch of Caterpillar. So it's a good, solid, long-term stock, so we like it. And 500 shares is nothing for us. But the hedgy part is taking 40 TZA April 10s, and TZA is currently at 11.12. So 40 April 10s, selling 40 April 15s, which are way up here. But we already hit that back in February. So 40 April 15s, it's a $5 spread times 40 is $20,000. Okay, so it's a $20,000 spread, and you're paying net $5,400 for the spread. No, I'm sorry, $5,400 in the money, sorry. The spread is zero, sorry, the cost of the spread is zero. It's 9,000 minus 4,000 minus 5,000, so you're paying net zero to be in the spread. You're obligated to buy Caterpillar for $100, but you're paying zero for the net of the spread, and you've got $20,000 worth of TZA protection. That's $10,000 in the money to start. Or $8,000 in the money to start. So that's a very good hedge too. Hopefully we don't need it though. So now John says, oh, it was right there this morning. I can't believe I missed it. Yeah, it's pretty bad. Somebody says you have no name, whoever you are. Yeah, I understand the balances. I'm talking about when would you look to play a leg down from our current lines? When significant lines fail, we constantly map out the lines, and they change as we break new levels. But that's why we have the big chart, and the big chart is, I think we did it right up here. And I'll open that in a new tab so it's bigger. So we have a significant, these are the 5% rule lines. You can see them right here, so that you can see them all the way down. And within those lines, you can calculate your own bounces. But look how neatly this is getting followed. See how it consolidates here and then moves to the next 5% level, comes down from this level to that level. Well, you're going to stop there. But see, originally, on the must-hold line, up to this line, we drew these lines years ago. These lines are from a chart that we haven't updated in a couple of years, these levels. So it goes, this line comes down, goes there. When you see this happening, then it hits the 50-day moving average. It doesn't, aside from our lines, there's other kinds of support. 50-day moving average is very strong support. And then it goes back to that line, consolidates, bit fails. Now, interestingly, it goes right through consolidates a little at the 50-day moving average, but plows right through the 200-day moving average. That's a super weak sign. Not only is it our must-hold line, which obviously nobody knows about. I'm not deluded that everybody follows a 5% rule, but not only does it blow through our own must-hold line, but it totally blows through the 200-day moving average that everybody follows. That's a big problem. You don't want to see that. That's a major, massive sign of weakness. Now, had all the indexes done that, I would have been panicking myself. But it was just the NYSE. Still very, very bad. But it was following the other indexes, which were the drop amount was following the other indexes, which were heading down to test their 200-day moving averages. But again, Russell, tiny consolidation at 200, immediately falls 5% further. So that means that none of these guys are done. They're almost all these indexes are probably going to go down another 5%, which means that what's happening right now is just a prelude to a much bigger drop. And so where do you short? You short when they cross significant lines that are worth shorting. We calculate those constantly. And like I said, this morning, 25.3 was the line I calculated was where we should start shorting that. But you have to, every day you make a new low, you have to recalculate and say, well, here would be the bounce line, here would be this. But of course, these big lines on the chart, they never change. So we always know where our 5% lines are. So in other words, if the Russell fails the 5% line, which is 1500, that's very negative. But I don't want to short the Russell because it's lower than everyone else. Which index hasn't really corrected yet? The NASDAQ is still up 30%, and the S&P is 25%, the Dow's 20%. So really, it's the NASDAQ that's the most shortable index. It's the most likely to correct, except then you have to take into account Apple, which I think is the least likely stock to have a major correction. And I did the math on that last week, and I forgot what it was, but I remember I said there's a certain point of Apple. Maybe I can see it. Yeah, I mean, if Apple comes back to 190, which is only $20, $30 down, so 15% correction on Apple, and I'll sell every freaking stock we have to buy Apple. I absolutely want to own Apple at 190. Anywhere in this range, I absolutely want to own the stock. So here I would cash in a good part of my portfolio to buy Apple. You get down to here, and I'll mortgage my house and everything else I got, because it's just stupid. I mean, this is going to be a $2 trillion company. Forget it being a $1 trillion company now. Eventually, it's going to be a $2 trillion company, and for good reason, not for stupid reasons. Not just because everybody likes to buy them, because they make that much money. Because they're going to make $100 billion a year in profit. And they're making like 55 billion, 60 billion now. So it's not like super far-fetched. They're going to eventually make $100 billion a year, this company. So yes, I absolutely want to own them for 180 bucks. This is basically the $1 trillion mark right here. So the PE at this point drops below 20. That's where you want to start picking them up. Narija says, do you like FCX? I do like FCX, but not now, because it's not in a good place. I mean, they're first of all, they're a falling knife. So that doesn't look good. I like Freeport. They got oil. They don't have oil. They don't really have oil anymore. Mostly just gold and copper. But they got copper. They got gold. But the trade issues with China aren't going away anytime soon. Gold's recovering, but it's only like about 25% of the business, maybe less than 25% of the business. And certainly we're into a bit of a global slowdown. So they can go down or float down here for a very long time. Conceptually, I like them. I mean, last time we bought them, they were 5. And I was banging the table on these guys. 3 years ago, maybe. I think it was a show that we did at the Javits Center in New York. And I did a presentation, and this was my pick for the presentation at the time. It was $5, and I was explaining how ridiculous $5 was for them, no matter how bad the market was. Now, $10 is not $5. So I like them, and I want to keep an eye on them, but I don't necessarily feel compelled to do something about them at this point. Meanwhile, let's talk about, I'm going to be on Money Talk later on BNN, which is Canada's Bloomberg. They got a show at 7:30 called Money Talk. And once a quarter, I go on the show. And we have a Money Talk portfolio, and we only make the trades on the air. That's the rule. We only make trades on the air, no other time, no changes in between shows, much as I want to sometimes. But every single trade is announced live on the air. Although, I do print it up here because the show asked me to. I think it's only fair. The show always asks me the day before to tell them what we're going to be trading. So I let the members know what we're going to be trading. I show them what I'm going to be showing the show people. They have a little bit of advantage over the people on the TV, I guess. So speaking of trading, I'm scheduled to Money Talk, blah, blah, blah. All right. So first of all, we're up 91.3% for the year. And let's see right now, because we're having a bad day. So we'll see if it changed much. Oh, no, went up. I don't know why. The same positions are now higher than they were yesterday. I don't know why. It doesn't matter though. I mean, things fluctuate during the day. But it just shows though that it's a solid, considering the market's down, Dow's down 200 points and this portfolio went up, it means that we have a well-balanced portfolio, that we know what we're doing. But the point is, I want to make a big point about portfolio management and so on and so forth. We started this portfolio last September with, you can see it here in fact. On September 6th last year, we had $50,000. We're currently using $30,000 in margin. We have $85,000 in cash. We're using very, very little cash for these positions. That means we're selling a lot of premium. But that's what we are. When I say be the house, I'm constantly hammering on be the house, be the house. Be the house is the shorthand reference to, and if you put in Be the House on YouTube, you'll get our video on Be the House, Not the Gambler. And Be the House is our overall strategy, which says, look, there's a casino and people play games and they think they're going to win the games, and some people win and some people lose. But you know who makes all the money? The casino makes all the money. Why do they make all the money? Because statistically, they're not gambling, they're selling risk. Okay? When you spin a roulette wheel, you get 35 to 1 if you hit your number. But how many numbers are on the table? 36, but there's actually more than 36. There's 38 numbers because there's 0 and there's 00. So whenever you're at a roulette wheel with 00, some roulette wheels only have 0, not 00, but very few. Whenever you're at a roulette wheel that has 00, that means that the number 36, the number 0, and the number 00 are all extra numbers. They're all higher than your 35 to 1 payoff. And how much higher? 3 higher than 35%. So that means the odds are basically 10% against you. Every time you spin, there's three numbers that you're not going to get paid for. Yeah, you can bet on 0, 00, but the point is you're only going to get back 35 to 1. You're not getting the right payoff. So the more you keep spinning, the more you keep losing. It's inevitable. Even when you win, if you just keep playing, you'll eventually lose it. Every time they spin the wheel, you're losing money. Whether not directly, but statistically, you're losing money. And they don't care if you as an individual wins or loses. In other words, if you flip a penny and you pay out 1-to-1, right? And the penny comes up heads. And you it's going to be even in the end, right? I mean, I hope I don't have to explain it to anybody. You flip a penny, theoretically, it's going to come out heads and tails the even amount of times. But obviously, over any run, there could be a streak, right? So you bet against the first guy, and he wins, and he doubled his money, and he runs away going, I doubled my money flipping pennies. And this next guy, you flip a penny, he loses, and he's wiped out. He only had a penny, he lost his penny, and you doubled your money. Now you're even. But one guy's wiped out and one guy doubled his money. Okay? The guy who, and the thing about Vegas is the guy who got wiped out, he doesn't go home and brag about it. But the guy who doubled his money goes and tells all his friends how great it is to play flip the penny, and they all come to Vegas to flip the penny. So you have an endless supply of people willing to flip the penny with you. But as you see, flip the penny is not a Las Vegas game because it has even odds. Games with even odds are not what they play in Vegas. They play games where the odds are in their favor. So, and by playing constantly when the odds are even a teeny bit in your favor, the more you play, the more you win. So our investing strategy is based on teaching you to be the house, to sell premium, sell risk to other people who think they're smart and think they know where the stock market's going to go. Because I say that's bullshit. I say it doesn't, look, you can be really smart. You can have great instincts for whatever. I have great instincts. I'm really smart. But I still would rather be the house and collect the premiums because I know that's going to win. It's a sure thing. And that's why this portfolio, which sells a lot of premium, goes up 4% when the Dow goes down 200 points. It's actually good for us when that happens because we've sold so much premium in these positions. And this doesn't account for the changes that we made yet. Anyway. All right, so I hope I explained that well, and then please ask questions if I didn't, but I'm trying to get this across. It's so important. Okay, back to the thing here. All right, so that portfolio started last September. How do we construct it? All those old positions are gone. The only thing left, there is something left over. LB, we sold some puts of LB. And those are still there. And here's one from 2017. Wait, WPM, well, that's this 118. And this WPM that was left over from something that we sold. Otherwise, these are all new positions. So in February, we added something. In July, we added something. February, July. So every time I'm on the show, we add something. Now it's October, and we're adding something. What was I going to say next? Yeah, so we add these positions one by one. We didn't go crazy. We started with $50,000, and we didn't go crazy and spend it all at once. We added when we saw a good stock that we thought was going to go higher. So we sold ALK puts. What is it? What does this mean when you sell a put? We sold the $60 puts of ALK. We sold them for $8.20. That's why we sold them. It was a crazy premium. I thought that was ridiculous. It's still ridiculous at $6.55. ALK is at 63. When you sell the $60 put for $8, it means you're getting $8.20. You're getting paid $8.20 in exchange for promising to buy the stock for $60 between now and 2020 if the person asks. Now they're not going to ask unless it's well below 60. Otherwise, we just keep the money. So we collected $4,000, and at the moment it's up 20%. So what's our trading plan? Our trading plan is between now and next January. ALK will stay over 60. These will go worthless, and we'll gain the $3,275 in market cap. SQQQ is a hedge that we added in July because we were worried about the markets going into the summer. So far, not paying us off. But also logically, look, we paid 7,000 minus 26 is $4,400. We paid $4,400 for this spread. It is a 5 times 20. It's a $10,000 spread. We paid $4,400 for. So our upside was $5,600. I think we also sold some short puts against it, but I don't know what happened to them. I guess they're gone by now. Maybe we didn't. Anyway, so it's a small protection hedge. At the moment, it's showing that it's only worth, $3,500 basically. So it's actually lost money so far, but that doesn't make any sense because the June 10 calls at 1338 or 138 in the money. The June 15 calls at 1338 are out of the money. So if it expired today, this trade would be net 138, and it would close at $2,600. So it's not a losing spread. What's happened though is that the short calls here have gained more premium than our long calls. Our long calls barely budged, only up 60 cents. The short calls went up $1. So it looks like a loss, but it's really not a loss at all. It's actually on track. It's actually going the way we want it to go. It's just on paper, it's a loss. And you have to understand that about your options to know what it's going to pay. So here I mentioned that, and here I say we should gain 32.75. For every position in your portfolio, you should have this down. You should know exactly what you're going to make on it and what your plan is. ABX. It's a long-term bet on gold that pays up to $12,500. It's currently at net 2225, so it's good for a new trade, obviously, because you're going to make another $10,000. And again, I have a trading plan. I expect to make this position is going to make me $10,000 over by January of 2020. That's my trading plan. That's why it's there. I know why that trade is there. I know how much it's supposed to make. I know whether it's on track or not. And if you think about it, why would you not know this about your portfolio positions? If you can't answer that question about every position in your portfolio, you're doing it wrong. Believe me. And again, let's go back to the casino model. Do you think that the guy who owns the blackjack table doesn't know exactly how much he expects to make in a day and how much people are betting, and he knows if the game is going right or wrong at any given time? You're damn right he does. In fact, I had a friend of mine. She used to be in charge of checking the numbers at Caesars, and they had every single slot machine, every table, everything. She would look for discrepancies, anomalies, anything going wrong anywhere with red flag. They had an exact amount. Every table was supposed to produce X. Every machine was producing Y, and they knew how. And each dealer, they knew how much each dealer was producing. So in other words, this guy makes this much money, this guy makes this much money, and then they start looking at it and saying, well, why is this guy making more money than this guy in the same amount of time? And they look at like how many bets were made, who sat down. And sometimes you have a better shift and more money is spent during your shift. But other times it's like, well, what are you doing differently? What is this guy doing more so than the other guy? Now, sometimes they want the dealer to be differently. They want to encourage him. Like if you play 3-card poker, which is a table game, there's this bet where you bet to, if you get a royal flush, you win a jackpot, but it's a huge jackpot, but it's a royal flush. You're not going to get a royal flush. So you're going to lose so much more money than you're going to win. It pays like 5,000 to 1. I think the odds, well, I don't have to think. Let's find out. What are the odds of a royal flush? There you go. See, this is funny. I didn't even realize it was that bad. The odds of a royal flush are 1 in $650,000. Okay? Yet the 3-card poker game pays you $5,000 if you get a royal flush. Pays 5,000 to 1. So it's paying you nothing. It's paying you 5,000 here. It's paying you 1/100th of what it should pay you for the payout. So the dealers, it turns out the dealers who are good at getting people to bet that, and it happens all the time, because I'll sit down, I don't play it. I'll play 3-card poker, but I refuse to play that because they want another $1. But you got to put another $1. Well, I'm not giving you $1 every time you deal a hand in case I get a royal flush. I said, that's stupid. If I get a royal flush, I'm going to win some money. I'll be happy. I don't need to win more money as a bonus because the only way to win more money is by giving you $649,000 first. They encourage you to play. And they do, and the dealers are trained to do this. They put peer pressure on you. They say everybody else is playing. Whenever somebody else wins, they will see, not a raw flush, of course, when they win, you win for various things. But whenever somebody wins, they will see, and all the other people love going, see, we told you to play that. All the old ladies like, oh, we told you to play that. You had a straight, you would have won 5-1, you know? And then we say, what are the odds of a straight? Here, what are the odds of a straight? Like a straight's 5-1, STR. Not a straight flush, a straight. What? Look, a straight is that much too. No, that's not true. What are the odds of getting a straight? Oh, here you go, poker probability. All right, save me a lot of time. Straight, 254-1. There you go. It pays you 5-1. So, you know, of course, when everybody, now here's the thing, because there's 5 people being dealt cards at the table. So every 50 hands, which is actually only over the course of an hour or two, so every 50 hands, somebody's going to get a straight. Somebody's going to get 3 of a kind, somebody's going to get a straight, somebody's going to get a flush, and they'll get paid. And they all go, ooh, see, it was worth it. It's the stupidest thing in the world. Anyway, but that's the point. They want you to play because they're giving you terrible odds. And the more you play terrible odds, the more money they make. And yes, some guy is going to walk in there and put $5 down and get paid 5,000 to 1 or whatever the hell they pay you. That's bullshit, though. That guy's going to be thrilled. He's going to run around telling people the rest of his life how he won $5,000 on a royal flush in a stupid 5-card poker game because he only sat there for an hour. And he lucked out. Somebody's going to luck out. You know, you go to the hospital, this guy got hit by lightning. He'll tell you, I got hit by lightning. He didn't luck out. It just, if the odds were better, he would get hit by lightning than he would get a raw flush. It was more likely to get hit by lightning than get a raw flush. But don't think he's going to go bragging to his friends. Well, it's still a good story. Anyway, be the house. So in other words, so we're trying to teach you to stop being the idiot on the other side of the table and stop playing the odds and stop gambling with your money and take this side of the game. Sell the premium to other people. And that's what we're doing in all these positions. And because we do that, and you say, oh, well, you can only, but if you do that, you can only win this much because you already sold the calls. I don't care because that much is a lot of money. That much is 460% of my starting cash. Okay, on GE, that much is 200% of my starting cash. On GIS, that's 385% of my starting cash. Not only that, though, but I'm running it like a business because I know exactly how much money this game is going to pay me. And at any given time, I can tell you whether my trade is on track or off track. It's a business. It's not gambling. I'm no longer gambling. I am now running a business. My business is to identify good properties, which are stocks or what I call properties, basically, and I use those properties to generate an income. So my skill as an owner of properties is to identify good properties that are going to do what I think they're going to do over the next 2 years, and they don't have to go very far up. Most of these trades are very conservative. The ABX trade is a 10-15 bull call spread. Okay, so 10-15. Oh, when do we take this trade? In July. So in July, depends when in July. In July on the 19th, so in late July. So right about here, probably earnings or something like that. But sometime in late July, we said this seems very low for ABX, and we took a position. And we sold, but we didn't take a giant position, they're going to go way up. We didn't say they're going to go super high. We said they're going to get back to 15, I think, over time. So we bought the $10 calls, which were way down here, and they did go down that low, and we sold the $15 calls. So this is a range we're playing for. And we gave ourselves a year for it to come back. It's already coming back, basically. So very conservative, but that conservative play pays us 460% back if we hit our number. And GE too. GE, we've got we have a 13-18 spread. They're at 13 now. GIS, we have a 47-50 spread. They're at 44.50. LB, we have a 27.50-35 spread. They're at 29.50. All right, and that one is not doing it's flat, but it's fine. And WPM, we have a oh, that was left over from the old trade. That's why that's sold. We have this one. This is our actual trade. It's 22.50.30 bull call spread. And because Wheaton Precious Metals was our trade of the year back then, that's why. And so the January calls will expire are worthless, and this is low in the channel, so we've been waiting those things out for them to expire. And blah, blah, blah. And then we're actually rolling it and getting more aggressive and so on and so forth. But we're always going conservative. Our new trade is the 15.22.50 bull call spread. 15.22.50. We're looking for it to get back to there, but in 2 years. But in every single trade, what am I going to make? I'm going to make 197% here, 385% here. I'm going to make 1,665% here. I'm going to make 435% here. I know exactly what I'm doing. That is the difference between investing and gambling. I am an investor. I am putting money into something that I expect to return a certain amount of money, and it's in a very, very controlled environment where I can measure the performance of my properties. Any given time, any day, I can see how my stuff is doing, and I can make small adjustments to make them more, to push them in a more profitable direction. Like here, we're adding a hedge because I said, you know what? We're up 95% for the year, and I want to make sure that we don't lose it all. Now, we already did that because last quarter, but in July, when we did the last review, we went to a huge amount of cash. We now have $85,000 in cash. But these open positions, even though they're taking up very little cash, they are taking up $30,000 in margin, and they are very leveraged. So they can cost us money. We don't want to give this cash back. We want to keep getting cash in. So we're taking a hedge here that pays us another $20,000. So we have the one hedge that pays us $10,000. This hedge will pay us $20,000. That's $30,000 downside protection. Plus we have $80,000 in cash. So worst comes to worst, hopefully we can end up close to 90,000, even if the market drops another 10, 15% from here. Hopefully we'll end up netting the same amount of money, basically. And then these positions, and again, you have to consider that. Even if the market drops, I still want to be in these positions long term. And that goes to the spreads too, by the way. I know exactly how much money my spread will pay me. This spread has a $12,800 upside potential. That's going to add on to the $70,000 of potential here. And by the way, every quarter I do this review, every quarter we say how much money we're going to make with the remaining positions, and every quarter so far we have hit our mark. So people always say, well, how do I make money? How can I make money following these things? Take this freaking portfolio, copy it exactly, and wait a quarter. That's how it works. I can't make it simpler than that. And look, I'm not a fan of people just following trades like that. That's terrible. What's more important is you learn the concepts. Because you can do this with any stock. These are just the ones I picked for this portfolio, and I'm always looking to balance. It's like I always try to balance things out. So we have the hedge, we have Caterpillar because we don't really have any industrials in this portfolio. We did Micron, we added because we don't have any semis in this portfolio. Well, GE is an industrial, sorry. But we have, what do we have here? We have an airline, we have a gold miner, we have an industrial, we have a food company, consumer goods, we have a clothing store, and we have another mining company. So we're two miners, so we're mining heavy. So we're adding a chip maker, and we're adding also the pot company. We're not officially adding that because it turns out that TD Bank, who sponsors the show, Money Talk, they are not fans of cannabis companies, and they've already made that known to the producers apparently. So they would prefer not to have people on touting pot companies. Now I said, even if it's an ETF, it's just an ETF. They're not actually a cannabis producer. They're an ETF tracking cannabis producers, but they don't want to get into it. So officially, this cannot be part of the Money Talk portfolio. I'm pretty clear, Laura. I love this trade. Still trying to get my lunch in every once in a while. So, On the beige book is out, and I don't think it was good because the market's still weak. I'll get back to that in a minute. So we have the pot trade, it's net 1,500. It's a $40,000 spread that you're getting into for $1,500. It's just a broad-based bet on marijuana companies. And we're taking the $25 calls, which are way down here, and we're selling the $45 calls, which is back at the high, and we're giving it 2 years to run. And how much are we going to make on this thing? We're going to make $38,000. I know how much we're going to make, $38,500. If we make $38,500 on this one, and we make $12,800 on this one, that's $50,000, which is 100% more on the portfolio. Just 2 more trades, and I can make another 100%. Okay, it's not that complicated. We only ever touch these trades once a quarter in this portfolio. We only trade it when I'm on the show, which is once every 3 months. We do not touch it in between. We don't do anything. It's completely hands off. And the premise of them is that we're taking positions where we're selling much more premium than we're buying. Why? The MJ25 calls are $950, so I'm effectively paying $34.50. 25 plus $950 is $34.50. That's what I'm paying for MJ. Where's MJ now? $32, $33. So I'm paying a $250 premium here. How much premium am I selling? I'm selling the $30 puts for $7. It's above 30, so that's 100% premium there. And here I'm selling the $45 calls way up here out of the money for $525, 100% premium there. So if it's a 32, forget 32.90, it's 32, let's say. So $7 this money, which is 20 times 7, 14. So 14,000 of this money is in the money. It's not premium. I'm not the idiot paying premium. I'm paying 5,000 in premium, but I'm turning around and selling 17,000 in premium. So if we assume MJ is actually worth something, and I'm not an idiot for paying $32 for it, which is pretty much where it is now, then what have I done? I've bought a property, and I've turned right around and I've used my property to sell premium risk to other people. And I've only spent $5,000 of risk. I sold $17,000 of risk. So I've netted $12,000 of risk sale to other people against my own $14,000 of intrinsic value in what I bought. So I've actually sold almost as much money in premium. In fact, that's what he's saying at $1,500. I sold almost as much money in premium as my entire position cost me, which means that anything above 30 is going to be a huge profit for me. Anything above 30 is big money for me. I start off at $10,000. At 30, it's $10,000 pure profit. Why? Because I let some other sucker bet that the stock's going to be below 30, and he paid me to bet that. Another sucker paid me to bet it's above 45. Now, what's the nice thing about that? I took money from both those guys. They can't both be right. It is not possible for them to both be right. Now, my leanings are that it's going to go up. So since my leanings are it's going to go up, I covered the guy who thinks it's going to go over 45. So if it does go over 45, I could care less because I have $25 calls. That means I'd be $20 in the money further than he will be. So I'll net $20 on the trade. It could be $1 million. I'm still going to get $20. Doesn't matter what it is. And he'll get $1 million less $20. That's fine. So that's how he'll net $20 on the. I'll net 20 on the trade. He'll make $1 million basically if it goes to $1 million, but I won't. I'll make $20. I'm capping my gains, but it doesn't matter if I'm capping my gains when my upside is 2,566%, does it? There's no reason to be greedy when you can consistently put together trades like this. You will build wealth. You will become rich if you just stick to a basic plan. Except for Donald Trump, basically every single casino owner in the world gets very rich. I guess even Donald Trump got very rich, but he bankrupted his casinos. All right. Questions. NYCB had results today. No questions, just in case you want to look. I don't want to look. It's a bank. I don't know what they do. Now I got to look. I didn't care what the results were. Here the oh well. We are playing NYCB and we expect them to come back eventually, but not today. Still, they held $9. That's all right. At least they found a floor. On GE, why aren't we short some more calls? Let's see. What GE? Are we talking about the ones here? Oh, because I think I'm very bullish on GE at this level. I think that I don't want to overcover them. That's why. Yeah, there's room within these positions to gamble. We can gamble too. And gambling is just to say sensibly, I think this stock is currently way too low, so therefore I'm not going to completely cover it. You have to make a judgment call sometimes. You don't have to. You can play completely conservatively, and you'll just make a little bit less money. I mean, again, I'm taking a chance on whether I'm right or wrong, but I'm pretty good at calling these things, so I'm making a judgment call on GE. Brian says, can you provide a hedge for the January timeframe, TZA, SDS? Well, we just talked about TZA, it's right on the top of the post. So that, and then if you need another one, ask in chat later. I'm not going to stop the whole thing to start that to find a whole new trade. Oh, Trump is discussing suspicious packages in the White House briefing room. That's interesting. All right. Tom reminds me the Fed is there. Burns says, MJ, there's already a bull call spread losing big. The one in BMN is something. Where do you keep the other? No, I think we have one in the short-term portfolio actually. Yes, it was April, so I'm not. I mean, basically it's the same concept, but I don't recommend doing the January. It's not. I don't think it's as good of a play. So if you want to do it, we'll talk about it in the chat room later. You can ask, and I'll see if I can put something together for you. But I don't recommend it. I'm not going to stop the whole webinar just to set up a play. I don't believe it. Where are we? In the short-term portfolio, do we have MJ? No. Oh, there it is. Yeah. We were trying MJ out in the short-term portfolio. That's right. And yes, it is down big. And we decided to, we made adjustments to that. I don't remember what it was. Let's see. That's why it's in the short-term portfolio. We thought we might have to make adjustments. So when do we do the short-term portfolio review? Is that Thursday? No, I only said it was good, still good for a new trade is what I said at the time. So MJ, oh, no kidding. What happened? When I said that, that was October 18th. And we had the 35, we had 20 of the 35 calls. We sold 15 of the 50 calls, and we sold 10 of the $30 puts. So that was like a week ago. And what seems to have happened, they were at 39 at the time. Now MJ has fallen to 32, which isn't really that far, but apparently the long calls really got whacked in price. And so currently they're at a very low price. They're at 690. The short calls are still holding up much better than the long calls. These are down 50%. These aren't down 50%. And the puts have gone up, so it's gone very much against us now. We're down $6,000 total, or $7,000 total. But that's fine. It's a small entry relatively for the short-term portfolio and the long-term portfolio. And what we're going to end up doing is we'll probably end up taking the loss here on the $10,000. We're going to roll it to the long-term portfolio and take up a much bigger position. Something more similar to when we just started on the in the money talk portfolio. Yeah, don't forget the primary purpose is the short-term portfolio, which is up 185% for the year, 184%. The primary purpose of the short-term portfolio is to hedge the long-term portfolio. So, we do take a gamble, and what we did with this one is we weren't sure what it was going to do, so we wanted to keep an eye on it, and so far it's not doing very well. But I'll be very happy to take that low price and roll it into a new position, because I still like them, definitely. These guys, we might leave these guys to die on the vine. Because if we take a $10,000 loss here, we sold these guys for $10,000. So if these eventually expire worthless, then we'll be even in the short-term portfolio, but in the long-term portfolio, we'll pick up this benefit of $10,000. So I like that idea. And instead of 30 puts, it's still lower than 30, so it doesn't really matter if they're losing money. As long as it stays above 30, we're in good shape. David wants to look at the API, he means the EIA report. And what about the beige book? Which is more important? Let's take a look at the petroleum status first. I don't think there's going to be much in the petroleum status report, though. What? Oh, that's weird. It came right to it. That's unusual. So what do we have? Last week? Wait, what? What? Is this right? October 19th. Yeah. Crude inventories increased 6.3. Gasoline down 4.8. Distillates 2.3. So that's 7 million. So a small drop. But look what happened. We went from 1920 to 1911. We actually went down 9 million barrels. Why? All other oils. There's a big drawer in all other oils. Look at that. We actually do use them sometimes. The SPR had a small drawdown in the SPR also. And this is interesting. Oh no, 2.3. Okay, distillate. Blah, blah, blah. So all of the oils really changed that category. So we actually had a much bigger draw than it looked like on the headline. That's interesting. So I guess I would take a more bullish stance on oil than what's probably showing. Look at these exports of 3.2 million barrels a day is being exported by us. That's crazy. Wow. Look at that. And look at the refineries. Wow, they're plowing out oil. But of course they are. They're making a ton of oil because we're exporting it all. Somebody's got to make it. This isn't oil, this is products, but we're exporting all this product. We're only importing 6 million barrels a day. That's like half of what we used to import. That's really amazing. Huge amount of U.S. Look at this 20 million barrels a day, right, being supplied, and we're only importing 6 million barrels, not even 6 million barrels. That means we're making 14 million barrels a day. That's more than Saudi Arabia makes. We are producing a hell of a lot of oil. If it wasn't for these exports, it would be piling up all over the place. Look at 3 million a day. That's 20-something million barrels a week that we are exporting out of the country. That's an entire day's supply we're exporting. So the actual U.S. demand is terrible, but we make it up by sending it out of the country. If we weren't doing that, the oil people would be in huge, huge trouble. Where is oil now? Yeah, CSC is holding up because really that report's pretty much more bullish than you would have thought. I would play gasoline long here into the weekend, 183.5. It's not a bad place to play gasoline. How's everybody else looking? Oh, still that 27 line over there. Why is that MJ? Why are we looking at that? YM. So 24,950, we're below 25. He's low, that's sad. 69.55, 14.96. I wouldn't play that. So he's over. So if these guys start crossing back up, then maybe we can play them over. But the gasoline, The dollar's really strong. Where's the dollar? Here's the dollar. The dollar's super strong. See, if the dollar calms down, it'll give these guys a boost. So I think on the whole, if we can get to 182.5, I'd really like to go long on gasoline. Oil, yeah, I mean, it's not a major catalyst, but the report wasn't as bad as it seems. That's the key takeaway there. Oh, these are going up. What time is it? 2:30, 69. Okay, so who's the lowest? Who's the lagger? He is NASDAQ, 69.60. Certainly moves better than the Russell does. If he gets over this green line, I think we should take a look at a long. So we'll watch that. But oil's getting lower. That's going to hurt the S&P somehow. We'll see what happens there. So let's see. We talked about that stuff. We talked about that. Oh, the beige book. You know what? I don't want to read the beige book. Where's the Wall Street Journal? WSJ.com. Hopefully they read it. Trump steps out. That's interesting too, right? So Trump's been like all over on Powell, like blaming him for all the market sell-offs. Because Trump took credit for the market going up, so now he has to blame somebody else for it going down. Dunkin' takes aim at Starbucks with new espresso. Oh, I'm sorry. Starbucks is shaking in their boots. Here we go. Oh, I am subscribed. Stop that. See? Stupid thing. All right. Businesses said they were optimistic about economic growth conditioning, indicated concerns that tariffs push up costs. 12 districts reported modest to moderate in growth at the beginning of the fall. The Fed says latest roundup. I forgot. You know what's called? The report based on information has highlighted uncertainties, particularly among manufacturers. See, now this is from before the market turned sour, and it wasn't really a glowing report. It seems like. Prices are going up, business costs are going up. They have to try to pass along costs to the consumers, higher input costs. And we're going to have inflation, guys. It's coming down the road. Nobody's really pricing that into the market either. Trump discusses suspicious packages. You better do something about that, dude. You're next. Tariffs have promoted a specialist strategy for some businesses struggling to bear the material costs. Virginia display case manufacturer said it's looking to import materials from somewhere other than China. Employment costs rose at modest or moderate, so they're all rising. So employment costs are rising, that squeezes margins. Labor shortages continue. This is all stuff the Fed has to raise rates when they see this kind of stuff. They got inflation, they have rising wages, they have labor shortages. They have to raise rates. It doesn't matter what Trump says. They have to raise rates. Otherwise, they are going to end up letting like the inflation genie out of the bottle, and we're in big trouble. Cape Cod restaurant industry has suffered ongoing acute labor shortages and placing restraint on growth. That's right. You can't have any cheap labor. You can't have immigrants anymore either. One firm, you gained shortage of workers to ramp up growth. The firm said we had collaborative robots. Wow. Isn't that weird? As a kid who used to read science fiction 50 years ago, I'm like, wow, that's like something from a book I used to read. The firm will add cobots or collaborative robots. Labor shortages should translate into big up in wages. Wage increases were described as modest or moderate. Labor departments can continue hiring. Blah 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 blah. So there's nothing really big in this labor in the beige book except for this crushing, slow-moving grind of inflation, and inflation that's also eroding margins at companies. And don't we invest in companies? Yes, we do. So things are not as great as you would hope. And you can see that from this. This is not a good day. Look at the NASDAQ's down another 2.5%. 2.5%. And again, the 5% rule says this is the most you should expect an index to ever go down in a day. It can go down more, but that's a catastrophe. There's nothing catastrophic happening today. This is how they're moving, 2.5% a day on no particular news. And the other ones are down 1.25 or more than 1.25, but 1.25 and 2.5 is very significant. 2.5 though, which is a lot for an AMX to move down on a dip, which again is a reason though to play the Nasdaq bouncy. So let's take a Nasdaq long. Since that's as much as it should be down in a single day, then let's see, we didn't catch the bottom. Oh wow, we missed the bottom by a mile. Holy cow. Where's my elevator? Damn. All right, let's just go one long and see what happens. So 69.60, we got a long. And I guess if he crosses over 15, but let's see how this one does. Damn, I wish I saw that. What were we doing then? So the point is below 2.5% is a good reason to go long all by itself. Because you definitely expect things to bounce off a 2.5% line. That's what the 5% rule is all about. Oh, and look at this. Holy cow. All right, so now we're at 66. And I think we should put a stop below 65. What the frick? Wow, dude. That's crazy. That's some quick money, huh? All right, let's put a stop at 66 now. Whoop. Let's put a stop at 67 now. Well, let's put a stop at 68 now. This is great. Keep raising those stops. 68. Stop. 69. Wow. 70. Seriously? Okay, fine. There you go. That was easy. And there's no reason you don't have to ride it out, because look, now the Dow's right over 25,000, so you can play that. It's got a tight stop right there. If he crosses over 15, you can play him. You don't stay with the same one that's doing all the moving. You know, we can just switch into here. I'll switch into the Dow. Now we get a long on the Dow, and if it goes below 25, we're going to get out with a very small loss. But this one's locked in. And if he goes over 15, then we can pick him up. But our stop on the Dow is here. It's 24. Let's say 5 below 24. And how much? What? Oh shit! That was fast. So our stop on the Dow is going to be 24,995, which just hit. So let's get out of that. So better to lose it there than lose it here, where it costs a lot more. We're going to lose 85 bucks or more because I didn't catch it. I think we'll get it. If I cancel it, then I can start again. There we go. See? Anyway, so lost 65 bucks. All right. The thing is, though, that's what we call getting a fresh horse. In other words, that thing moved up $200 something. I don't remember where we started, but it moved up about $250 in 5 minutes. So you got to say to yourself, do I always make $250 in 5 minutes? Is that normal? No, it's not normal. So if it's not normal, take it off the table. If it's real, it's going to keep going up, but then it'll drag the other guys up with it. You can play one of them. So I tried playing the Dow. That didn't work out. Although now it's back over, so I could have stuck with it. But the point is, you know, I tried playing the Dow. That didn't work out. This guy's got an obvious floor to pass through over here. So I can just switch to another one. If it's a real rally, everything's going to start going up. If it's not a real rally, then I'm glad I got out. You got to be quick to take losses and quick to take profits. You can't have it both ways. Okay, you have to know what you're in there for. I'm in there to make sure you guys make some money during the seminar. So therefore, when I make 230 bucks here and 370 bucks there, that's 600 bucks. That's good money for one seminar, right? That's my job. My job is to make sure the money's made and locked in. Or I guess minus 65, of course. So if he crosses over 15, we want to play it. But you know what? While it's crossing over 15, you got to pay attention to how hard it's been to get over 15. Because that'll give you an indication of how easy it'll be to fall back under 15. Now, see, he's coming back down, so we could play it again, but these moves are not looking very pretty, are they? Look, he's failing 25. We don't have a really good indication of strength. We read the beige book. It was not particularly a great report. It's showing inflation and stuff is coming in. So there's nothing to get too excited about. We're just playing for a bounce off the 2.5% line. And by the way, there's the 2.5% line on the NASDAQ is right here. Right there, 62.50. So if you're going to go long, this is a place to go long, basically. but now it's below it. So now you're certainly not going to play it. It's certainly not going to play it if it's below it. So now I don't want to get it until it's back to 69.50 or over 62.50. One of the two, though, has to be either much further down or back up. Oh. But I have to have all my signs. He's not over 25, so why should I play at all? He's not over 15, so I don't have a very good confirmation here. And if he does get away from me, then I look to see who's my next horse. Which one can I play next? I can play Dow, although he hasn't been very good to us. Now let's try the 60. Oh, how did that fill? That's weird. I clicked, I did, yeah, I filled it 62.50, even though it was nowhere near it when I clicked it. So now, remember, 62.50 is exactly the 5% line on the NASDAQ. I mean, sorry, the 2.5% line. That's as much as the index should end up dropping for the day. So even if it does go a bit lower, it's very likely to come back to that level. I hope so. Whoa, Jesus Christ. I've never seen anything like this. All right, fine, I'll take that. Now we're up to 490. I mean, you can just do that over and over and over again. Just keep making, the trick is take the quick profits, get out. Like I said, if it's real, then these guys are going to start clicking over. But when, this thing's up and down $200 at a clip, it's like, why should I'm not going to stick with it like that. If he's going up better now. He's over 25, so now I want to switch. Oh, missed it. No. Oh, too high. Oh, no, 14.99. Great. Okay. So now we're in at 1,500 on this guy. Right? Because he's over, and he's over. So who was lagging? He was lagging. And he's got a great stop line. If he fails 1,500, we know to get out. He fails 1,500. I'm saying it. But hopefully we can catch that one. So anyway, if he fails 1,500 when the other guys start looking weaker, not just if he randomly fails it for half a second. Because look at the way these things are bouncing around. It's crazy. All right, so I'm taking a quick bite of my lunch, and we can get back to this in a second. So you see, we're working very hard for our money today. So who says that? They said RB, gasoline. Oh, yeah. Now, the NYMEX closes at 2:30. Right now, the NYMEX is right now closing. So if there's selling pressure, this should be it. I didn't think the report was that bad. We're going to come into a weekend. It's a little tricky. I'm not super enthusiastic about it, but I think we'll play it. It's a good price. Let's wait and see where it stops. Any lower? Yeah, 182.08. Up, 182.05. 04. It's ugly close. 02. Should I take it? 01. Don't be greedy. All right, there we go. Oh no, that was short. Son of a bitch. Wrong side. Uh-oh. There we go. Wow, I messed that up. Well, maybe I didn't. Maybe that was a Freudian slip. Anyway, so I'm going to leave that one. That one's a keeper. I'll keep that into Friday. So not definitely into Friday, but at some point between now and Friday, I expect to get up at least another penny, and hopefully you can get back to 84, maybe 85, which would be good for $1,000. So that one we're going to have to see over time how it goes. Index was not looking that strong. So that's more of a longer term play. I'm not going to worry about that one. Wow, look at him. Now, if he fails 25, I got to get out of this. I should have gone out of it already. I was messing around with the other thing. 2506. Is this because Trump's saying stuff? I don't know what's going on. All right, now 1498 drops. If I add another one here, it drops me by a penny. So I'm not going to watch gasoline. I want to get back to the NASDAQ because I need to see what's going on. Oh, what about the dollar? How's the dollar doing? Dollar is still very strong. See, that's the thing. If the dollar gets weaker, it will send everything else up anyway. So that's why gasoline is a fun trade to have with the dollar that strong. Well, I'm not satisfied with this trade at all. It's not really doing what I want it to do. But we have a bit more of a rally into the close. But he's still holding his 2.5% line. As long as he's holding his 2.5% line, I think it's a valid premise that we get a bit of a bounce. So we shall see. All right, was there something else I wanted to go to? We did the beige book, which was not very exciting. Indexes are basically hovering along. I just definitely don't like the way the NASDAQ is this week. It's not encouraging at all. Look at the daily chart of the NASDAQ. Look, a big, see, they're either 2.5% move here, 2.5% move here, 5% move. That's a 5% move in one day. So basically 2.5%, accelerating decline 5%, claws back most of the 5%, but then drops right back and is now past that 5% line. This is setting up, if we finish down here on the NASDAQ, we're setting up for another 5% drop, probably finishing. So 5% is 2 boxes like this. So we'll be setting up for this, and then that will not stop. It'll slow, and we should be back down to about 6,400. All right, so the NASDAQ is probably better short than a long at this point. And that means we probably want to add more SQQs, because that's not good. And you know, if you catch a 5% day, you don't have time to add here. You have to do it when you feel it. And if we finish below 69, if we finish below this low, whatever that was, let's take a look. If we finish below 69.50, let's say, that was a low from the other day. If we finish below 69.50, I think we're going to have to short. I think we're certainly going to have to add more SQQ hedges. So we have about an hour to make that decision, but we have to see where it finishes. It's going to be kind of interesting. Not good here. I'm not failing though. It's not failing yet. I'd still like to add one more right here. That'll bring me down to 1490. Oh, no, it's not low enough. Sorry. No, it's not really low enough. It's not worth it. Well, let's see, 1490. No, if I can get in at 1498. 0 down here. If I can get in here, that's worth it, because then all we have to do is get back to 1499 and we can get out again and get back to 1. Because these lines are holding, so it's not terrible yet. Oh, here we go. That was easy. All right, now let's hope we can get out. So I did that to lower my basis. What happened? Was I accidentally shorting? It was brilliant if I was. I think I hit the wrong side of that. Because I just bought one. I know I bought one. And yet I'm flat. I'm going to have to watch that on the replay and see what the hell happened. I think I was accidentally short when I meant to be long. That's interesting. So do I still want to be long? No, you know what? That was just lucky, and I'm not going to play it. I was only playing long because I figured I'd get a bounce and we can get out. But now we're out, and apparently I wasn't even long. I was short. I didn't even realize that. It was stupid. So you understand what I'm saying? Though, is I must have clicked the wrong side because I just clicked along, and now we're flat. Now we have no positions. So that means that the last one we were in must have been short, even though I had intended to go long at the time. But like I said, it's kind of it's a Freudian slip because I guess it just doesn't look that pretty. Look what's happening. Everyone's deteriorating. I'm telling you, the NASDAQ looked like in for a nasty, nasty fall. So I'm going to take the last few questions now, and we're going to have to get to the chat room and discuss possible changes to the portfolio and maybe a last-minute decision on the Money Tour portfolio before the show tonight because I don't like the way this is going. Ori says, a bunch of good companies are supposed to report this evening, ABX, Sharp, ALGN, ANET. Can you give me an opinion on earnings? Maybe they could pull up the NASDAQ. I don't think so. Like I said, I think the momentum on the NASDAQ and the overall overboardness of the NASDAQ and the fact that Apple isn't really back where I said it would be, I said 215 on Apple or something like that. It's down to 200. It starts getting very, very interesting. Right now at 220, it's not that interesting. It's not like I think it's got to be bought. And I know it's a very thin line. You talk about 10% difference on Apple one way or the other, but that's about as low as I think Apple can go. There may be individually good companies, but there's still plenty of Netflix and Amazon and bullshit like that is so ridiculously valued. They have tons of room to fall. And also, by the way, Tesla tonight, everybody is now expecting Tesla to say something great tonight. If they say something bad, all hell is going to break loose. People are going to start really thinking about whether or not these companies are worth it. Now I'm telling you, Netflix is not much. Netflix is so ridiculously priced. Amazon is so ridiculously priced. You're talking about Amazon is probably $300, $400 billion overvalued right now. That's like 10% of the Russell. That's not what you think. That's not what you. I think it's probably more than 10% of the Russell. It's probably not even at $4. I don't think the Russell is $4 trillion. So Amazon is overvalued by 10% of the Russell. That's a statement right there. These companies have a long, long way to fall. People are throwing money at things that are like, it's insane. GOP Senator Hatch backs Powell after Trump faults the Fed. The chairman, went away. Anyway, so Orrin Hatch, who chairs the Finance Committee, is backing up Powell and his actions. Oh, and look at that. Weaker and weaker things are getting. Ugly, ugly, ugly. All right, so I think we're going to have to buy another 80 of the SQQ shorts, and we're going to also have to shore up on the options opportunity portfolio and the Money Tour portfolio, because this is, I'm telling you, when you see this kind of action like this, because what's going on? Each one of these bands is about 2.5%. All right, let's see. 200 divided by 70, 500 is 2.5%. Okay, thank you. All right. So each of these bands is 2.5%. So you have a two, and don't forget that's a 5% rule, right? So you have 64 to 76. What's 2 times 64 is going to be 12, obviously. So a 20% move up here, boom. How much is a retrace off a 20% run? A weak retrace is 4%, and that would be 2 of these boxes basically around here. So that's a weak retrace. A strong retrace is going to be 8%. So we can now look down to at least another about there, about here. All right. So this is what you would call a strong retrace down here. If this line fails, you're past a strong retrace. There's no actual support until you get all the way back down here to 6,400. There's no particular support for that. That's devastating. That's another basically another 10% down in the NASDAQ. And if we're finishing near the lows, it's an indication that we're consolidating for a move down, not a move back up. And then you've got to say, well, how well hedged is our portfolio? Can our portfolio stand up to that? And, we can, but why should we lose the money? It's like we have plenty of money. We should put it into a hedge just in case. If it doesn't come up, then we'll do some buying. No big deal. But that's how we're going to look at it. So we're going to review that later. In the last hour over at PSW, I'm going to finish up on all that stuff, right? So thanks everybody for coming. Have a lovely, lovely week, and we'll do it again next week, of course. And no, that's very bad. Very, very bad. Right there, 2.5% rule. Below this, and if they close below that line, you can look for a 5% drop in the next 2 days at least. That'll bring it all the way down to 66. And then probably we'll settle down around 64, maybe a bit lower. But don't forget, 6,000 is still 20% higher than they peaked out in 2000. These are crazy numbers. We never should have been this high. All right? So that's where we are, and sorry about the doom and gloom, but that's where I got to call them like I see them, all right? Have a good day, everybody. Take care.